Hi, my name is Mark Longo from the OptionsInsider.com and the Options Insider Radio Network, coming to you today from the trading floor of the Chicago Mercantile Exchange. And today we're going to talk about everyone's favorite trading name these days, Facebook. Now, Facebook has been making a lot of headlines lately, most recently because of its dramatic sell-off post-earnings. In fact, it recently broke through that critical $20 price level, which has been a critical support level and also a critical psychological level for this name for quite some time. Now, this pronounced sell-off has brought out a lot of bulls in Facebook who are thinking the stock is poised for a near-term retracement. This pronounced sell-off has also brought out a lot of options traders who are attracted to Facebook because despite a pronounced sell-off in volatility throughout the marketplace, Facebook options and Facebook volatility remain relatively active and relatively inflated from a volatility perspective. So that makes them very attractive to option sellers and also something to be wary of if you're an options buyer. So with that in mind, let's look at two ways to play a bullish outlook on Facebook in the near term. Let's start with you're a near-term bull on Facebook, but you're also worried about some continued downside in the near term. You think in the very near term, the stock may continue to drop before it turns around. So you want some cushion to the downside. Let's say 20% from the current trading price. You could sell the September 16 put, which is currently trading for around 50 cents. That allows you to collect 50 cents and effectively work a limit order of $15.50 in the stock, which is of course the $16 strike price minus the 50-cent premium you collected for writing that put. Now, if Facebook turns around in the near term and rallies to the upside, you keep that entire 50-cent amount. If Facebook continues to decline through options expiration, then you will purchase the stock at a substantial discount, roughly 20% to where it's trading right now. Again, if you're a longer-term Facebook bull, that could be a very attractive entry point for you. Now, let's say you're some of these wave of bulls that are coming into Facebook that are much more aggressive. They've seen this aggressive sell-off in the stock, and they think the stock is poised for a very aggressive near-term turnaround. We've seen a lot of people coming in from an options perspective and piling into very near-term, very near at-the-money calls like the September 21 calls. Now, the problem with that is that ignores what we talked about earlier, which is the inflated levels of volatility right now in Facebook. If you simply come out and outright buy options, you are paying an inflated premium. You're paying much more for those options than you would in a normal scenario. So any long options position in Facebook right now really should be paired with a corresponding short options position to offset your volatility exposure and also to reduce your premium outlay. So in this scenario, rather than just simply piling into September 21 calls, which are currently trading for around $1.40, you could offset that purchase with a sale of the September 23 calls. Those are trading for around 70 cents right now. And what you've done there is you've legged into a very simple vertical call spread. You've reduced your volatility exposure by combining a long premium position with a short premium position. You've also reduced your premium exposure, cut it in half from $1.40 down to 70 cents. That's certainly more ideal or certainly preferable. A more interesting way to construct that trade is to combine that simple vertical call spread with the sale of the short put that we discussed earlier. Now, remember, they were the September 16 puts. They were trading for around 50 cents. So now from a volatility perspective, you've offset your long call position, the long September 21 position, with two short options positions. So you've reduced your volatility exposure dramatically. You've also reduced your premium exposure dramatically. You've reduced your premium outlay from $1.40 for the call outright down to 20 cents now. Remember, that was 70 cents minus the 50 cents for the put. So now you have outlaid 20 cents on this trade. And if Facebook does indeed turn around and rally aggressively as you predict, then you stand to make up to $1.80 on this trade, which is a substantial return on a 20-cent investment. And indeed, if Facebook continues to sell off, then you will be purchasing it at that 20% discount to the current trading price, which, as we said, may be an attractive level for some longer-term Facebook bulls. So there you have it, two ways to use options to express bullish outlooks in Facebook. If you'd like to hear more options trading tips or education or unusual activity or breaking news from the options market, then by all means surf on over to theoptionsinsider.com or search for the Options Insider Radio Network in iTunes.